Dear friends, welcome to this chapter on depreciation accounting. To understand depreciation accounting, we should understand that there are two categories of assets. One category which will appreciate in its value, which is called appreciable asset, and the other category of asset which will lose its value day after day, and they are all called depreciable assets. So understand, appreciable assets will increase in value and depreciable assets will decrease in value. So depreciation accounting is nothing but accounting for decrease in value of assets. Now, why does this depreciation arises? See, the depreciable assets loses its value, number one, on account of its usage. Any asset which you use, it will lose its effective life, right? Every asset will have a life and you cannot expect work from that asset beyond the life. So once you start using, to that extent it loses its value. And number two reason can be the technological changes. Probably you could have purchased an electronic gadget and a product superior to that electronic gadget, or which is more advanced than if it comes in the market, automatically this product will lose its value because it will not have any replacement value, number one. Number two, nobody is going to buy it because there is an advanced version. Number three reason can be passage of time. You purchase the asset even if you don't use it. If you are going to keep it idle for a certain period, it will lose its value, because with the purchase of asset you become owner. So anybody who is going to purchase that will become only the second owner. The second ownership will always reduce the value, number one. Number two, whether you use it or not, if you are going to keep it idle during this period, that will also result in loss in value. Simple example could be purchase of car. Purchase a car, keep it in the shed for 6 months, then try to sell it. You will be able to sell it only at 60% or 70% of the value. Simple reason, you have purchased it, you have kept it. Whether you have used it or not, you have had the asset at your disposal. So the passage of time would also reduce the value of asset. And four is wear and tear. Wear and tear is as similar like usage, but here due to heavy usage also the value could come down. So these are all the reasons that the value of assets could come down, and it becomes necessary to account this reduction. Now, why we are accounting only reduction? Is it we are accounting only reduction in value of asset? No. Just look at here. See, depreciable assets are those assets which will predominantly will be giving you revenue. Probably depreciable assets will be like equipments, it would be like machinery, it would be like your building, factory building, admin building. So 80 to 90% of the depreciable assets would be giving you revenue, will be generating revenue for you. So using this depreciable assets, you will be generating revenue year after year after year. So let's say you have a depreciable asset and it has a life of 5 years. So what happens in this entire 5 years, say in year 1, this asset would generate revenue for you, right? Now one point I will clarify here. See, assets are something which will find a place in balance sheet. See, we know there are two financial statements. One is the income statement, which is P&L, the other one is balance sheet. Assets are the element which will appear in the asset side of the balance sheet, and depreciable assets will appear on the asset side of the balance sheet. So we are not taking the depreciable assets to P&L. So no expense is booked in the name of assets in P&L, but those assets are used for generating revenue. So what does the income statement basically captures? It basically captures income and expenses. So here, using this asset, we are booking one item in the income statement in the name of revenue. Then we are also supposed to book matching expense. See, any revenue generation will have expense attached to it. So if some revenue is generated by using this machinery, then there will be some expense on account of using the machinery, right? Yeah. So in the same year, we have to account the expense on account of using the machinery. See, by using the machinery, this machinery has lost its value. There is a usage, there is a lapse of time. Say if it is for one accounting year, it has lost its value for one accounting year, number one. It has lost its value on account of usage. It has lost its value on account of wear and tear. So there is reduction in value of asset that can also be called as expense or loss. So if you are accounting revenue generated out of this depreciable asset, then you also have to account for the loss in value of asset, and that would be called as asset expense, and that would be given the name depreciation. So in year 1, if you book a revenue by using this asset, then you have to account for the expenses out of the asset in the name of depreciation. So year 2, if you generate revenue, then in the same year you have to account for the expenses incurred for earning the revenue on the asset, which is depreciation. So similarly, we will do it for year 3. There will be revenue and we have to account for the expenses in the name of depreciation. So it will happen for entire 5 years. So the underlying concept is, if you are recognizing revenue by using this asset, then you have to recognize the expense or loss incurred in using that asset as well. To understand this concept even in a fair way, we'll look at this example. Let's say there is a machinery costing 100 crore. The cost of the machinery is 100 crore, and this machinery is capable of generating sales of 50 crore for every year, and this machinery has a life of 5 years. So cost of machinery is 100 crore. It can generate 50 crore of revenue every year, and it can generate solidly for next 5 years. So 250 crore revenue is assured out of this machinery. Now, apart from this machinery expenses, let us say there are operating expenses for achieving the sales, right? For achieving sales, many expenses have to be incurred, and we'll call them as operating expense. Let's say it is 25 crore every year. Now, let us calculate the real profit from this activity. So we'll have it for all the 5 years, year 1, 2, 3, 4 and 5. So what is the sales? It's 50 crore for all the 5 years. So we'll write 50, and we know there are certain operating expenses which is 25 crore for all the 5 years. So now we'll get what is known as profit, and it's going to be 25 crore for all the 5 years. Now, is it a fair profit? It is not a fair profit, because we have generated, or we have accounted for income generated by using this asset of 100 crore, but we have not accounted the loss in value of this machinery or the expense on account of using the machinery. So how we can account? We can account by calculating depreciation. So here the life value of asset is 100 crore and life is 5 years. So 100 crore divided by 5 is 20 crore every year it is losing its value. So we can account this 20 crore for all the 5 years as machinery expense, or in the name of depreciation. So we'll write depreciation is 100 by 5 years, which is 20 crore, and we'll account this 20 crore for next 5 years. So this would give us depreciation accounting for 5 years, and this would give us the profit before tax, and I would say this is the fair profit, because in this profit we have not accounted depreciation, but here we have accounted depreciation. So we have accounted for usage of machinery and the related expenses. See, the focus is on, if you are making a sale, you have to account all its expense. By not accounting depreciation, you are not accounting major expense, which is the usage of machinery. So now the profit before tax is 5. So this is the real and fair profit. Fine. So now, by providing depreciation for 5 years, what we have done? By providing depreciation for 5 years, we have set aside profit for next 5 years. What do we mean by set aside profit? See, the owners can take only the profit for them, right? So in this case, the owners can take only 5 or say 20, I mean 5 5 is 25 crore as profit for them, because their profit taken or whatever they can take as profit is limited because of depreciation accounting. Depreciation accounting has prohibited the owners from taking to the extent of 100 crore, right? So by providing depreciation, what we have done is we have limited the owners from taking 100 crore, or we have set aside the profit for 5 years, which is 100 crore, and this 100 crore is nothing but what is the original cost of asset. Here if you note, yeah. So in 5 years we have set aside 100 crore, and what it would do, it would enable a replacement of asset. Probably after 5 years you may not be able to purchase it at the same 100 crore, but you will have 100 crore plus you have to put something to buy new one, but this would enable a replacement of asset as well. So understand, by accounting for depreciation, you are finding the fair profit, number one. Number two, you are restricting the owners from taking away all the profits, because some profits should be available for replacement of asset. So by providing depreciation, we have enabled replacement of assets. And another important point, the depreciation also accounts for reduction in value of assets. Here we have focused that we are accounting for the expenses related to the sales, but on the balance sheet aspect, the depreciation accounts for reduction in value of assets. So we'll see what it is. Let's say the cost of machinery is 100 crore and the life is 5 years. So in balance sheet, this machinery will be appearing as asset. Okay, so say the life is 5 years, so we will provide all the 5 years. So in the first year, this machinery will appear at 100 crore value, but we have calculated there is a depreciation, right? So depreciation will reduce the value of asset. So from 100, 20 will be reduced and the net value will become 80. So this is in year 1. So depreciation is recording the asset value at its net value, that is after depreciation. What will happen in year 2? The gross value will remain at 100, because gross value will be the same throughout the life. But now the depreciation is, in year 1 we have provided depreciation of 20, and in year 2 another 20 would be provided. So here depreciation would be 20 plus 20, 40. So 100 minus 40, the value of asset would be 60 now. So from 100 it has gone to 60 in the second year. In third year gross value would be same, whereas depreciation will be 40 plus current year depreciation of 20. So it's 60, 100 minus 60 is 40. In fourth year, gross value would be 100 and depreciation would be 60 plus 20. So that is 80. 100 minus 80 is 20. In year 5, it will be 80 plus 20. So you will not have any value for the asset, because at the end of the 5 years it loses its value. So depreciation accounts for reduction in value of asset in its balance sheet, and in P&L it will show the expenses incurred or loss suffered for achieving the sales out of using those assets. Thank you.